Check.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning, welcome to the show. Of course, it is hump day as we get into this middle of the week. More economic data coming out today, of course, and we saw weaker than expected economic data yesterday. That certainly is starting to provide some concerns. We talked about the Atlanta Fed. Their GDP now has been revised from above 4% to below 2%, about 1.8% actually for the second quarter growth. A big downwardly sharp revision as we see some of this economic data coming through. But you never know what you're going to get, with some of this data and what happens. The market's a good example. Like this morning, I'm driving to work and, I get to this crosswalk at this intersection, and an older gentleman comes walking across the crosswalk, right? Got white hair. He's kind of shuffling, working his way across the crosswalks, got his shirt on, no pants. I thought it was President Biden for a second, but but you never know what you're going to get. Economic data is the same way. You never know what's going to come in without its pants on. So that just tends to happen. Outside of that, everything else remains really kind of pretty kind of calm across the board. The one kind of interesting thing that is going on, though, is with semiconductors. Of course, the story's all about NVIDIA for the most part, but semiconductors are now outperforming software by nearly 3 standard deviations, and that has only happened twice over the last decade. So again, while everybody's very excited about what's going on with NVIDIA and artificial intelligence, et cetera, it's not surprising that these trades can get a little bit ahead of themselves. We tend to crowd into these investments from time to time. We get all excited about them. They run up a lot, so we all pile in more. And it's just one of those things as we continue to kind of go through markets. We pile onto trades, we drive them up, and then of course, kind of expectations get well ahead of reality, and then we have to have a reversal. So again, it's just something to kind of keep a watch on. We've gotten very far into this trade so far. And again, doesn't mean the trade is over by any stretch of the imagination. It doesn't mean that semiconductors are going to crash, and it doesn't mean the market's going to crash. It just means we're probably going to go through a period where there's some consolidation in these stocks. Could last for several months to work off some of that excess kind of exuberance that's in the market. So again, as always is the case, and this is why we recently kind of reduced our position in NVIDIA just before earnings, is that things have gotten just a little bit too far. And just, it doesn't mean to get out of the positions. It doesn't mean to sell the positions. But it does mean to, take some risk off the table, rebalance a little bit, kind of keep the greed in check a bit. So again, it just, we've seen these before, seen these standard deviations before. We've seen these extensions before. And they do tend to correct over a period of time. And again, it's just difficult. There's an old German proverb talking about how trees can't grow to the sky. And this is kind of the same way with stocks, is that in kind of the early stages, it's very easy for a company to grow very quickly, right? So if I have 100,000 in revenue, it's pretty easy to go to 200,000 revenue. 200,000 to 400,000 is pretty easy. $1 million to $2 million is pretty easy. So I can double my rate of earnings growth fairly easy when I'm small. But once that I start getting into billions and billions of dollars of revenue, it's much more difficult to grow at a rate to support the valuations of the underlying company. It's one thing to go from 1 billion to 2 billion. It's very different to go from 10 billion to 20 billion in sales. So again, it's just, try to keep some of these things in perspective. Again, there's nothing wrong with any of these companies. They're growing great. The fundamentals are there in most cases. But again, prices have just got a little bit extended. Outside of that, though, everything else with the markets we've talked about is pretty fine. And again, just, this is kind of the same thing that we've talked about here recently. For the S&P, for the most part, domestic stocks are vastly outperforming every other market in the world. So, if you just take a look at the market cap of the S&P versus emerging markets and international markets, there's just a vast difference. Money flows are just coming in from globally into the U.S., and this is helping elevate the U.S. markets versus other markets, just simply those money flows. So, as we just kind of think about this, and again, we've talked about this before, but just kind of pay attention to the technicals because they'll give you a good indication of what's going to happen next. Okay, here's what you need to know, though, before the bell this morning. Over the last couple of days, we've seen a fairly big correction in oil prices. And oil prices have been kind of pulling back here just over the last few days. We were holding a really good support line right along the 100-day and the 200-day moving average. That completely broke down a couple of trading sessions ago after OPEC Plus basically, kind of said, hey, we're going to allow some more production to come online. And that's pushed oil prices down. Now, we're getting fairly oversold here on a short-term basis, so you could expect a bounce in oil prices here short-term, but we are definitely taking out very important moving averages. It does suggest that we're likely going to see oil prices come down. Now, we're sitting on support that goes back to basically February of this year. So again, we've kind of done a round trip since February, but again, we're getting pretty oversold here. So kind of look for a bounce. Now this is going to translate. There's a very high correlation between energy prices and energy stocks, obviously, because of the underlying commodity. But this is probably going to allow you to have an opportunity to maybe look at rebalancing some of your energy exposure in that commodity space on that bounce. So look for a rally in oil prices somewhere between $76 and $77 a share. If you need to reduce or rebalance your energy exposure at that point, you certainly can. But again, taking out all of these moving averages potentially puts a little bit more risk into oil prices of lower energy prices. And that's going to occur if we do continue to see slower rates of economic growth. If some of this economic data that we're seeing coming through right now continues to accelerate a bit over the course of the next several months, weaker job growth, weaker employment wage growth, some of the other economic data we're seeing on the GDP front, retail sales, if all that continues to slow down and show more weakness, that's going to translate into weaker economic activity, less demand for oil prices. So you're potentially going to see lower oil prices over the next, several months heading into the election, if that's the case. So again, just something to kind of think about here, just kind of keep a watch on. Again, we are oversold here. So again, getting a bounce in oil prices here short term would not be surprising, but just keep a watch on it. This will also translate very short term. Lower oil prices also translate into weaker inflation pressures, which will, kind of put, and again, we've seen this here lately just with the expectations for Fed rate cuts now up to 2 for this year. But if oil prices can continue to trend lower here, that could translate into a lower reading on inflation pressure in the next couple of months, which would certainly, kind of push those expectations for further rate cuts higher than they are currently. Outside of that, of course, the 10-year Treasury, we've seen, because of this inflationary drop, potentially, right? That's happening with oil prices. That's been translating into into interest rates as well. Interest rates had rallied back a bit heading into some of the recent economic data. That data, a lot of people were expecting to be stronger than it was, came in weaker than expected. So we've completely kind of round tripped that little tick up in interest rates. Now, importantly, we're starting to see a pattern here. We've got a double top in interest rates, now triggering a sell signal, once again suggesting lower interest rates coming. If we take out this last level of support on moving averages, we could see interest rates come back down to about 4.1%, maybe even 4%. Just on a technical basis. So again, just kind of keep a watch what's happening with energy prices, inflation, interest rates. They all kind of tie together. But that's what you need to know before the bell this morning. When we come back, pick up Danny Ratliff. Got a few things to get into this morning, everything from Roaring Kitty to 401k plans. So don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Danny Ratliff joining me, and good news is he has his pants on. So, this is good news. It's always important. Show up with your pants.
Hold on, is this a problem?
So, a couple of things.
Radio, so how can you really tell?
Well, yeah, but it's not just radio anymore. It's
that is true.
You've got live stream.
Look at that camera angle.
Exactly.
You're not here on Fridays. You never know what you're going to get with Rich. So.
I know that. That's that. I do tune in on Fridays because in the mornings on Fridays I'm generally writing the newsletter and stuff. So while I'm listening to you guys ramble while I'm writing the newsletter.
Yeah.
So yeah. I do know what I'm getting on Friday, and generally it's some, imitation of Janet Yellen. That's what I know on Fridays is almost a definite every Friday.
Well, you guys on the YouTube chat, you kind of facilitate this a little bit, guys.
Just a bit.
You're instigators.
So, a couple of things. You sent me an article this morning on Roaring Kitty.
Yeah, I think this is interesting. And he has been such a hot topic over the last couple of years where he's kind of found his way into the spotlight, disappeared, and then showed back up, right? Obviously, he's not the biggest, SEC is not the biggest fan of him. But, it says how Roaring Kitty's wealth went from $53,000 nearly $300 million and could one day top $1 billion. He's notorious. So if you don't know who he is, has his own Reddit, I guess you call it a channel. Mm-hmm. What do you call that?
YouTube channel.
Is it a YouTube channel?
Yeah.
Okay.
He's got a YouTube channel and an X account.
Well, I think he's been primarily on Reddit, and he has his Reddit boards, and so he is the one who has been looking at all the short sellers on specific stocks. Specifically, GameStop has been one. I think he did Bed Bath & Beyond, a couple others. And he's encouraged people to do specific trades, and which is why the SEC has frowned upon what he's doing. But the guy's made a ton of money doing so, and so he looks at how many short positions are on a specific company, and he looks at he can get them basically stopped out, more or less.
Right.
And he shared, I guess on the 3rd, a screenshot of what he had just done. Now, it's interesting because I think a lot of people see this and they're like, "Oh man, how do we duplicate something like this?" Right? Mm-hmm. And I think this is where it becomes an issue, and it's kind of funny because you look at some of the some large money managers saying, "Look, the most successful players are those that are just out of their minds. You have to be made of something different to trade like that." But from a risk management perspective, 99.9% of people could not handle it,
right?
Nor do it.
Well, and again, it's just what we see happen is that, and this is going to happen. This is what happened last time. This will happen again, is that he comes out, he does this, and the stock starts running, and you get everybody on Reddit buying the GameStop shares. And so the price goes up, and then they start going, I'm just going to have diamond hands. I'm just going to hold this because it's going to go to the moon. Well, he's selling, and he's selling his options. He's selling his stock. And they're holding on to it. So when the thing crashes, they wind up losing all their money because they never sold anything.
But he's the one yelling at everybody to hodl, right? Hodl.
No,
hold on for dear life.
He's like, no, I'm just buying this, and he just doesn't tell you when he sells.
Yeah.
No, it's all the Reddit crowd going, hold on for dear life, which is hodl, hold on for dear life. Hold on for dear life, diamond hands, all this. That's the retail crowd, and that's why the retail crowd usually loses money in this stuff because they're late in and they're late out.
Yeah, but you got to think he's kind of a genius. It's like the old school pump and dump from penny stocks, right? You let everybody know this great mass marketing scheme, and then the owners who, this company's likely not worth anything, they step out, kind of like GameStop. Is that worth a whole lot?
Well, yeah, and that's why E-Trade's now saying that they may ban Roaring Kitty from E-Trade. They may terminate his account, which is at E-Trade, because of stock market manipulation.
Well, he's a market mover.
Yeah.
I mean, when you think about it, look at the volume that he's done. If you look at the amount of shares that he has versus the amount of shares of GameStop, I mean, he owns like 6 or 7% of the company.
Yeah.
Which is amazing for just one guy behind a keyboard to do, who started with $53,000. So, I mean, he's done something right. Now, has he had outside investors? Where have these funds come from?
I swear I saw an article last time that this was going on back in 2021, right? When this was going on back in 2021, 2022? No, it's 2021. They even made a Netflix special about GameStop.
Did they?
Yeah, and but I remember reading an article, and I was Google searching for it this morning, but I swear I saw an article, and I could be wrong, and it wouldn't be the first time I'm wrong, but I swear I saw an article that he got a capital infusion from an outside investor that allowed him to, because he had like $53,000 of net worth to start with.
Yeah.
And I swear he got like a $5 million investment. I could be wrong again. I just don't know, but I think there was a capital infusion somewhere along the way to help boost his stake in the GameStop shares. But
nonetheless, even if he turned $5 million into $200 million, he's having a pretty darn good day.
Yeah, absolutely.
Yeah.
Well,
but this is always interesting to me. You find out all these things that happen. Like, another thing that I'm seeing a lot of, and I'm sure you've seen as well, and you probably get questions on, is like, what about these politician trackers that track all their trades?
Right.
What do you think about that?
Well, no, I mean, it shouldn't be. I mean, the whole, if you work in a public office where you're making policy, you should be allowed to buy treasuries. That's it. You should not be allowed to buy stocks, particularly if you're passing a semiconductor bill that is going to provide an $8 billion benefit to some specific company. You shouldn't be allowed to go out and buy the shares in the company before you pass the CHIP Act, right? That's if you and I did that, it would
be insider trading.
Exactly.
If we had knowledge of anything of that sort.
Correct. But this goes on all the time in Congress, and everybody knows this. I mean, it's common knowledge, but it is a very interesting case of the rules apply for thee, but not for me. And, so if you're in Congress, you can do a lot of things that technically nobody else can do. Martha Stewart went to jail for it. So
You think she'd be a little bit upset.
Yeah.
Right? But it is interesting because I see a lot of this, and you see where they're going after one specific person, depending on what side of the aisle that you're on. And, then you begin to look and say, well, where did these people actually get their money? Now, there's some that you can't figure out where it actually came from. And then you have others that, like Michael McCall, who actually from Texas, out of Austin, his wife was the heiress to Clear Channel, which sold, in 2008 for like almost $18 billion. And so the family has been giving money a little bit at a time. Now, granted, I saw something that he placed like 560 trades over the last year. So clearly he probably knows something that you and I don't know. But still one of those issues where, we've always got to kind of follow that bouncing ball. I think there's a lot of them out there, like you mentioned, Lance, so that, they're passing some big bill. And like next thing you know, how did you guys invest in a bunch of infrastructure or, then chips? That's not fair. But how does the average Joe follow that? I mean, I know there's apps out there. There's AI that allows people to do it. There's actually,
there's
programs.
ETFs.
Yeah.
There's actually 2 ETFs. There's one for Ted Cruz and one for Nancy Pelosi. By the way,
Who's winning that one?
Nancy Pelosi by a long shot. So yeah, Ted Cruz's ETF isn't working nearly as well as Nancy Pelosi.
So, well, never mind. I'm not even gonna ask why.
Well, it's just stock picks, right? So just whatever they're buying, and just Nancy Pelosi is much more visible about buying stocks related to specific bills that are getting passed, and generally ahead of time. Yeah. So she just does better by jumping on the trade before it occurs. And we saw the same thing when everybody knew we were going to shut down when Congress knew that we were going to shut down the economy. Nobody else did, right? They were out buying shares of Peloton and Zoom video and everything else before they shut down the economy, right? Because they knew that this whole work from home thing was going to be forced on everybody. So they were buying the stocks that were going to benefit from the shutdown of the economy.
So outside of having, insider trading pertain to them as well, what else could you do? Just do a blind trust? I mean, that's been something. Didn't Trump have to do that?
Yeah, well, and again, but this goes back to, we saw the same issue with the Federal Reserve. We saw members of the Federal Reserve that were buying stocks and, knowing that they were going to do quantitative easing, et cetera. So no, again, if you're in public office where you're making policy, no blind trust, no, you buy treasuries, that's it. And then when you get out of office, buy whatever you want. But while you're in office and making policy, you get to own treasuries.
Well, and then when you're out of office, that insider trading does finally pertain to you, but they're going to look the other way.
Maybe. But again, at least you don't have immediate access to the information and you're not coming up with the policy to pass.
Yeah, that's very true.
So you own treasuries. And look, all these politicians make millions upon millions of dollars being a politician anyway, so it really doesn't matter what your stock trading is doing. So you make far more just being a politician. Anyway, a couple of things. When we come back from the break, want to get into a little bit about preparing your finances for a recession. We're now not saying a recession is right around the corner, but certainly some data suggests that the economy is indeed slowing down. And look, the risk of recession, as I wrote an article just last Friday talking about the risk of recession isn't zero. And it's not. And there's still plenty of anecdotal evidence that suggests the economy is slowing down and that we could see much lower rates of economic growth that would impact markets at some point as earnings fail to meet those expectations from slower growth. So when we come back from the break, we'll talk about what you need to do to start preparing potentially for a recession. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
In the last 2 years, there's been a massive drop-off. Like, nobody's naming their kid Alexa anymore. But yeah, because you go, Alexa, stop that, and all your lights go off.
The Real Investment Show podcast.
And I'm sure the kids at school were getting teased. You know, hey, Alexa, ask a question.
Same show, your schedule.
I haven't heard of any kids being named Siri.
Not yet. I'm sure there are. I am sure there are. And there's probably some kid named Bixby somewhere.
At realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
He did it once, he did it again. All right, welcome back to the show this morning. So, lots of debate every day about the economy. And again, depending on what side of the aisle you're standing on, it's either a booming economy or you're near recession, right? And there's certainly some data that suggests that the economy is indeed slowing down. We've talked about this over the last few days. And like I said, we wrote an article just last week talking about the risk of recession isn't zero. And there's certainly some concerns there. So the question is, really, recessions are never known until after the fact. And this is, the big thing with the National Bureau of Economic Research. They're generally 9 to 12 months after the fact before they actually say, oh, yeah, the recession started there. So, what, and again, by the time we revise all the data, we don't know that we were in a recession until after the fact that the data's all been revised. So what if we're in a recession now and just don't know it yet, right? There's certainly some cases that you can make for that. People, whether it's job losses, we're seeing, the number of job openings decline rather sharply. We're seeing a lot of other data. And again, you hear the stories about high cost of groceries and people having struggling to make ends meet, running out of credit lines. So what if we're in a recession? Don't even know it yet. But, what do you need to do to prepare for it? And that's, Danny, what do you think?
Well, I think that there's a lot of things, and this is where right now it's difficult times because we've had a great run up in the market. I think people are concerned. I think there's more caution than what there's been historically at the moment, which I think is good. But also you see some of that optimism where, nothing can go wrong. And so inevitably, I think this is a great time to kind of take a step back and say, how do we prepare? What happens if this thing does fall apart? I mean, you've got a lot of indicators. We've talked about this. You've had leading economic index has been negative for how long? We've had, yield curves been inverted, 2 big recession indicators. Now you've got job numbers, which have been impacted. We've seen retail sales revised. We've seen all these things that, historically signaled there's going to be some issues in the future. So if history shows us anything, now one, this can remain probably, we would call it irrational longer than we can remain rational. Right. I mean, how many people do you know that have been on the sideline that are continuously on the sideline because there's always a reason not to be in the market? And there's a lot. But I think this is where you need to take a step back. And, I always go back to the financial plan, Lance, but I think this is crucially important in the sense that you need to know what can you physically, number one, what can you take from a downside perspective? We've always talked about a 10% decline should be the cost of entry to the market. You should expect that there will be a 10% decline at any given time. Part of playing the game. But what will you do during that decline? And can your funds withstand that if you're close or in distribution mode? The big number I hear all the time, Lance, is we're going to get a 50% decline. And I'm sure you hear that.
Because that's the 2 most recent bear markets that we've had.
Correct.
Was 2001 and 2.
Yep.
Right? That was a 50% decline, peak to trough, right? And then 2008 was 50% peak to trough. So that's all people can equate to because most people weren't around in 1987 when the market tanked, right?
Yeah.
Or 1974. I was 9 at that point. But 1974, we had the black bear market, and that was where markets, crashed, the Nifty 50, and people didn't come back to the market for nearly 20 years after that. So, it's just those, but the most recognizable bear markets have been just these 2 50% declines. Just so everybody equates that, the next big downturn is going to be another 50% downturn. And that could very well be the case. A 50% downturn wouldn't even get you back to the 2009 lows at this point. So, there's a long way to go from where we are currently, through a major corrective reversion of prices and valuations.
But that doesn't mean that we have to get back to those lows either.
Absolutely not.
I mean, we could see a significant decline without even getting all the way back to that.
Absolutely.
I mean, we're talking,
well, no,
decade.
but just from technical analysis, right? You put out a chart of the S&P, right? And people draw a line across those bottoms. 2002 bottom, correct. 2008 bottom, because they were about the same level. Mm-hmm. Right? And they say, okay, there's the bottoms. So this decline's going to have to be back to that bottom. Technically, that's the thesis. But again, But
the world has changed. The economy has grown.
Absolutely.
I mean, GDP is much different than what it was
absolutely.
then. Debt is much different than it was then. I mean, there's a lot of differentiators now compared to where we were then. But, I think if we're going to prepare, one, bracing yourself and understanding what may or may not happen in the future, but also not letting that dictate our whole investment philosophy or thesis. I mean, I think that, the first thing anybody can do is obviously shore up debt, make sure that we have emergency funds. I mean, this is the basics of financial planning 101. Set that emergency fund up. Set up an addition of financial vulnerability cushion. And then begin to, okay, you can weather the storm if it comes, and or do you have additional cash or capital that you can put to use? I mean, the one thing I think that a lot of people miss out on is that they just look at it as such a terrible time because everybody's all in, right? You don't ever get out. It's a buy and hold strategy. So you've got to write it down. You've got to get, you've got to wait for it to come back. Whereas if you have capital that you can deploy and you can take that more pragmatic approach, take that step back, man, what an opportunity these things provide. The volatility can be your friend. But I think we're always so cautious or scared of the worst that many people don't act on that.
That's right.
Well,
again, and again, this is why we've talked about before, the biggest mistake that a lot of people make is they get out of the market, but then
They don't get back in.
and they don't get back in because they keep expecting. And generally what happens is that the market corrects and you come down 20 or 30%, 40%. Finally, the pain gets too great to hold on. The dividend buyers that I bought the stock for the dividend. I'm just going to hold it for the yield. I don't care what the price does. There's a point that they will sell those stocks because they are simply losing too much money and the dividends have all been cut. And so they bail out at the bottom, right? And this is the typical. And then when the market starts to rally, they go, oh, well, that rally's not going to last. And it's going to crash again. And it's going to go lower. So they're not going to get back in. Then the market keeps rallying. Well, now it's too overbought. I can't get in. I've got to wait for a correction. Then the market keeps going 400% later. You're still out of the market because it's just psychology. It's just how we process pain and fear. And those things are more lasting than, the exuberance that we get of being greedy.
I don't know if they're more lasting or not. It seems like for some people they are, for some people they aren't.
Yeah.
But I get it. It's just your livelihood. It's things that you've built to protect yourself long term. Give you the freedom that you want in retirement. But it's also tough because when things are really bad, we all know somebody that's out of work. It may be you yourself. It may be a loved one, a friend, a family member. You hear the horror stories when visiting with friends and loved ones, and that is, I think, what makes it really difficult to see the light at the end of the tunnel.
Right.
For many, and that's the challenge I think that most face. But it's. That's why I think that if you have that plan, you understand yourself, your own psychology behind it, what you historically have done. And I think that's one thing that it's difficult for many people is that taking that step back to understand what have I done historically? How many people take that, that kind of introspective look and say, how do I typically react in this situation? What should I do differently? I mean, we always do this at work and with other things, but I don't know if people do that enough at home with their own personal finances to get that understanding of how they typically do things and how can they do it better.
Right.
Treat it like a business. You need to treat your finances like you're running a business. And all of a sudden, I think that, you'll look at it a little bit differently.
Yeah, and this is how we manage money, right? We always take a look at, risk versus reward.
Yep.
How much can we stake in this? And if it goes horribly wrong, what's the impact to the portfolio? And again, this is just part of the risk management process. Is saying, look, if I invest in this, like I could buy, I wouldn't do it, but literally I could put GameStop into a portfolio. And then the way I would do that would say, okay, if this thing goes to zero, what's the impact on the portfolio? So I buy 100 shares. I'm just throwing out a number. And if it goes to zero, it's going to cost me 20 basis points of performance. That's survivable, right? I mean, 20 basis points, it's 1/5 of 1%. Who cares, right? But if I put in enough of it in the portfolio that if it goes to zero, it wipes out 30% of the portfolio, that's not a viable risk reward. So again, people tend to get overly, anxious about trades and think, oh, the more I buy, the more money I can make. Well, they forget that what risk is not how much money you make when markets are going up. It's how much money you lose when things go wrong. And this is why the risk part of the risk-reward equation is so important. If your risk outweighs the potential for reward, don't do it.
Well, but I think that a lot of people look at that as well, and they say, well, I need to put more in because if this thing actually does go up, well, that's the problem with most of these like GameStop. Mm-hmm. You're usually not going to go buy just a little bit. Yeah. You're putting it in because you're hoping and expecting that this thing's going to go to the moon. So people get way over their skis, and then that becomes the bigger issue is that when it does drop that 30% or potentially more, what happens? Right?
Right.
Because now it's a big portion of the portfolio. It drops, it goes to zero. You're in trouble. Did you see all the people that bought Berkshire Hathaway during the blip 2 days ago? And a lot of them got their orders filled.
And did they get to keep them?
No, they got filled at like 600-some thousand.
Yeah.
And they didn't have the money. So, I mean, there was a lot of people that had just got completely wiped out, right? And it's like the trade never happened. They put a stop on trading. If you don't know, Berkshire Hathaway went down. What was it trading at?
It went to zero.
Went to zero. So people were buying it for next to nothing. and this is the A share, so currently $617,000.
Yeah. So basically, they just negated all the trades and said, "Sorry, you didn't get it."
Yeah, but I was starting to read some stuff, and there were people that actually did get filled, and they're like, "Man, we don't have the money. How are they going to go back and rectify this?" I mean, what a nightmare.
All right, quick break. We'll come back. I just did a quick piece of analysis for you on your correction story, so we'll talk about that when we come back from the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So you were asking about how big the next correction could be, right?
Don't say it because you're going to scare people to death.
No. It was interesting because just while you were doing it,
I'm going to get phone calls all day.
No. It's just a thought experiment. So nobody freak out, right? But, so Brent, you can bring up this chart for me. So what I did was I simply just put an S&P chart together and just did basically an info line from peak to trough of the previous two bear markets. And of course, from the 2000 peak to the 2002 low, from the 2008 peak to 2002 low, those are your two 50% corrections that we talked about back then. So, but, Danny's right is that over time, the economy's grown, the markets have grown a lot. And, so the next correction, back down to a support level of support, would not be surprising. And of course, I just use the 200-month moving average as kind of a baseline. It's a good running kind of base for, long-term growth trends of the markets. And, the 200-month low and the 200-month moving average all align with that 2008 bottom. So it's risen since then, right? So you shouldn't expect a reversion all the way back down to the 2008 low, as Danny was saying, but a reversion back to that 200-month moving average would be a 60% correction. So, but that would revert valuations.
But you said that was a 200-month
moving average, which is a good long-term trend for the markets.
Yeah.
And just, again, that's not exact. It's just, but that it does factor in inflation, economic growth over time. So again, if you're looking for a reasonable kind of proxy for what a big bear market would look like, 60%. And that would be outside the realm of reality. So again, it's just, but you got to have a lot of things go wrong.
That's like a 16 years, though, is what you're going back, right? I mean, that's...
Yeah.
Yeah.
So, I mean, yeah, it's a big decline.
That's a huge decline.
Yeah. But it would revert your valuations back to more normalistic levels. You're at almost 35 times earnings now.
But that wouldn't get you back to historical averages, would it?
No, it gets you back. No, it would get you back to around 15, 16 times earnings.
A 63% decline wouldn't get you...
60% decline would get you back to about 15 times earnings. 14, 15 probably, I would guess.
Man.
And that
so what would get you back to like a 2008 level? Because we were down to like, what, 9, 8, 9?
No, we were down 12.
Oh, okay. I thought we were lower than that.
No. So, yeah, 12, 13, 14, somewhere in there. We never reverted. So in 1974, that bear market got us to 6 times earnings. 1929 to 1933 had us down to about 7 times earnings. We'll never see single-digit earnings valuations again. I would, there's been because of all the monetary interventions, because of, Fed interventions and a more active Fed, and the evolution of hedge funds and private equity and all this other stuff in the markets, we've permanently shifted valuations higher. So, if you get down to 10, 11, 12, 13, 14, 15 times earnings, that's going to be the new low for valuations in the market environment probably going forward, just because of the advent of what we've done to markets.
Well, a lot more government intervention.
Well,
right?
But people are also quicker to respond, right?
Correct. We have a lot more tools and resources that are in the toolbox than what we used to have.
Exactly. So people aren't going to wait for 5 times earnings. They're going to start buying at 10, 11, 12, 15 times earnings, somewhere in there. And that's why we've done this kind of psychological shift in the markets that have permanently lifted valuation metrics.
So let's talk about what would have to happen to get down to those levels.
You'd have to have some other you have to have a credit-related event.
Yeah, a significant credit-related event, right?
It won't be just market sell-off. It won't be shutting down the economy. It will have to be a credit-related event of some sort that seizes up the credit markets to where people literally will not trade with each other, very akin to what we saw in 2008. Because, again, credit's the lifeblood of the economy. So you've got to have something that weighs on the banks to where they literally stop trading.
So are we in an environment where you believe with this slowing down of economic data, we've had a lot of conflicting data for a while, right? It was really strong, resilient, and then we were getting things revised now. As you mentioned, it may be that we find out that we're in a recession or were in a recession and now things have improved. But historically, if we get one of those bigger drops, it's smack dab in the middle of this thing, right? Mm-hmm. So with the economy slowing down, but not to the level that it's recessionary, and potentially we're seeing yields fall. Like you mentioned, we got a double top on yields, potentially going to see that drop. What happens there? Do we thread this needle?
Potentially. I mean, Brent, bring the chart back up for me. So if you just take a look at, if the market just reverts back to a 50-month moving average, which is about where we hit during the COVID pandemic. Well, it was where we hit on the COVID pandemic. So that keeps the market in a bull market. We don't actually go into a bear market. So a correction back to the 50-month moving average is 23%. So you have a 23% decline. You're still in a bull market because you've never violated the uptrend of the market. Then that's the key. The difference between a bull and a bear market is a violation of the uptrend.
Well, that just also shows you how far deviated from these
moving averages.
Yeah.
Which is Tuesday's article that I just wrote yesterday on deviations.
Because historically, a 20% decline would have been a bear market, but now it's not even.
That was an arbitrary measure back in '87, right?
But arbitrary, it's something that we've used forever.
Well, prior to 2000, but now we've run deviations so far away that these 20% corrections. Look, we had 35% correction during the pandemic, and it was a correction, not a bear market. Because you never violated.
Didn't feel like that, did it?
Because you never violated the uptrend. But even if things get really rough, right? We have a good deep recession, so a mild recession gets you 23%. A deep recession gets you somewhere probably back down to the 100-month moving average, and that's going to be about 45%. So there's a range in there, right? To where things can get, again, now you're talking about a pretty deep recession very slow economic growth. So negative 2% GDP growth on an annual basis. So a pretty hard recession, really high unemployment, really deep wage drops, those type of things. Of course, inflation is going to be, falling very sharply at that point. And the problem with that point is that once you start talking about that, the Fed's going to be very active, zero interest rates, doing quantitative easing. Whoever's president, it's not going to matter. They're going to be sending out checks to households again.
Ooh.
So that's the new playbook, right? So,
but it's inflationary. Look where it's gotten us to this point, right? I mean, not to mention all the other things that occurred, but
right. But if you listen to the government, it wasn't them. They didn't cause inflation. And I wrote an article on this. They didn't cause inflation. It was corporations that caused inflation. Those greedy corporations. Of course, we just went through all this on the show a couple of weeks ago.
Yep.
That corporations don't cause inflation, only government does. But yeah, the fact is that government wants votes, so they're going to send checks. Right. And they'll go, well, this time will be different. We'll send checks and we won't get inflation. Yes, you will.
Yeah, you're always going to get inflation by giving people a bunch of money.
Right.
So, all right. So you thread this needle. We're getting slower economic data, but nothing that suggests that things are falling off that cliff. So where does the market go from here? Does it just trade sideways?
Yeah, good.
Do we finally get rates? Do we see the Fed start to? You mentioned earlier.
Fed's
now we
cut
get
rates.
2. Yeah.
No, they're going to cut 2, and this year they'll cut 4 times next year probably.
Okay.
So, I mean, they'll eventually get back to zero. So, once the economy does slip into a recession and slow down, they will start cutting rates more aggressively.
We talked about tax receipts. What is that going to do to tax receipts and their income? So here's the problem I think the Fed has, right? You get into a recession. Mm-hmm. The Fed can't afford a recession because if you get a decline in tax receipts even further.
Why can't the Fed afford it? The Fed's whole job is to monetize the debt.
Well, because their debt
No.
It continues to accumulate. It gets higher, right?
No, they don't care. They're just buying assets on their balance sheet. The Treasury issues. Okay, so there's the big misnomer, right? People go, the government's printing money. They're not printing money. They're issuing debt. That's not printing money. They're not increasing the money supply. So the Treasury prints debt, okay, to get the money they need to replace the fall off in tax revenues.
Correct.
So they can do their spending. They then sell the bonds to the banks. Right, so the bonds are now sitting on the bank's balance sheets. Well, the banks need to get those bonds out of their balance sheet, right, so that they can convert those into capital that they can then loan out, invest in hedge funds, whatever they want to do. So the Fed buys those bonds from the Treasury, credits their bank account with the money for the bond. Mm-hmm. So now the banks get a reserve account credit for $1 billion worth of Treasuries, and now the Fed owns the assets. The Fed doesn't care. They don't care what the value of the asset does. They don't care if the value of the asset goes up or down. They're going to hold the bond till maturity, and then when it rolls off, they'll replace it with something else.
Yeah, but I'm talking about the Treasury. They're not getting the tax receipts.
Right.
You have this amount
of
Fed. Debt. Well, okay.
So you meant Treasury. Okay,
Treasury.
so when tax receipts fall, less revenue for the government, so it means the Treasury has to issue more debt. Yes.
Yeah.
Sorry.
Which is another issue, right? If you don't have rates at a lower place than where they are today.
Again, the Treasury doesn't really care that much. They just shift between bills and bonds.
Well, but at what point are people going to say enough is enough? There's enough debt. We're not going to, right? I mean, hey, I'm just throwing all these things out that this is what people are concerned with each and every day, right?
Stop voting for idiots. If you're tired of it, stop voting for idiots in office.
Well, you're going to have to, you can't vote for any of them anymore then.
You know what?
I mean, you can't.
So
because listen, it's not a one side of the aisle issue. It's all of them. They're all spending money.
So maybe everybody shows up to run for office. Nobody votes for anybody.
What happened there? The incumbent just stuck? We're stuck with the same idiots we've got?
No, yeah. I mean, if nobody's getting a vote, maybe all of a sudden we can get somebody else on the ticket. How about this? We just start writing in people. Let's find some really good candidates and start doing write-ins for office.
Mickey Mouse.
No, real good candidates. People that actually know how to run a business.
But that's the problem, is that no real good candidate really wants to run. I heard something the other day. The problem
Can't
is
make
that
enough money.
You have politicians you have people that want to be there. You don't need people that want to be there, that want the power. You need people that need to be there.
It's supposed to be a job of service.
Correct.
All right. Wrap up the show for the day. We'll see you next time.